buy these things because you don't know when silver's going to run, and you are willing to subject yourself to breathtaking opportunities because when they do run, the gains that you enjoy pay an awful lot of rent in a time value of money sense to compensate you for being early. I'm delighted right now to see the hate on social media that the small silver companies are enjoying. I think the problem, and we've described this before, is that investors look at a long-term narrative and they employ a short-term strategy. In other words, they think the price of silver is going to go up over 3 years, but they're afraid to hold the stock for 3 weeks. I'm old enough now that I've come to enjoy this habit. I seem to be a pawnbroker for people who are duration challenged. When the narrative gets ahead of itself and the stocks get frothy, you got to sell them a little. When the Twitter space on X is full of hate, you got to buy. Right now, the Twitter space on X is full of hate for silver and uranium.
Did you know that two of the most despised assets in today's market, silver and uranium, might actually be the hidden gems poised for explosive growth? According to Rick Rule, when social media and market sentiment turns sour on an asset, it often signals a prime opportunity for savvy investors. Remember the early 90s when silver shot up from just 50 cents to $40, rewarding those who saw the potential before the crowd? Today, we're seeing a similar scenario unfold, with uranium facing a significant global production deficit and rising demand due to the resurgence of nuclear energy, especially with new plants being built in China and beyond. These aren't just speculative plays. They're strategic investments that could offer substantial returns as the market catches on. Imagine being ahead of the curve, capitalizing on assets that most investors are ignoring or even dismissing.
I think that the U.S. has a stronger economy than people believe, but it's a two-tier economy. For people like me with access to credit, artificially low credit, low price credit, and the knowledge of how to deploy credit, this is the best possible economic environment. This circumstance is tailor-made for a guy like me. But most of the economy isn't made up of people like me. Most of the economy is made up of people who only have access to consumer credit, which is to say they're paying 20 or 22% on their credit cards, and they're close to maxed out. They're using credit to sustain wants as opposed to needs. They aren't using the credit in a credit arbitrage. In other words, using that credit to make more money to service the debt. And I think the chickens are actually coming home to roost. The problem with the level of pricing is not that goods have become more expensive. It's that the medium of exchange has become worth less. People don't seem to get that. While wages have been increasing, they haven't been increasing anywhere near as rapidly as prices have. When you look, as an example, at in my area, the functional minimum wage is $20 an hour. You can't get people to work for less than $20 an hour. You and I think about $20 an hour in the context of 20 years ago. But the truth is, if you make $800 a week, $3,200 a month in this market, you almost can't afford to rent in this market. So this so-called princely wage of $20 an hour compared to the statutory minimum at 7.5 or whatever it is, still doesn't constitute a living wage. And I think that dichotomy is increasingly impacting the consumer's ability to finance, to sustain the lifestyle that they would like to sustain. And I think that will yield financial and social problems. Now, the truth is that there have also been demographic forces and NIMBYism that have forced up the price of real estate. Real estate might not be descriptive of the broad market, particularly because of subsidized credit in real estate. And also in certain markets like Vancouver, British Columbia, because of the extra fees imposed on developers in development fees. There are certain jurisdictions in North America, Vancouver being one of them, as an example, where the construction of a rental unit involves incurring $200,000 worth of upfront fees before you buy the land or pound a nail. So there may be special forces around housing, but most of what you say, which is to say that the price of goods hasn't really increased in a real sense. The nominal value of the medium of exchange has declined. You know, I look at a lot of things. I do a thought exercise a lot where I value things in gold uh, rather than in US dollars. And if you have been like me, systematically investing in gold, not enough in retrospect, for 24 years, what you're what you're struck by is that the price of many consumer items that you go to buy in gold terms has gone down, not up. So the problem is much more the denominator than it is the absolute level of pricing. And investors need to consider that in terms of how they organize their savings in the future. I would urge the people listening to this conversation uh, to own gold stocks. I would urge them to deploy into the higher quality names before they indulge their fantasies with the alpha, with the penny dreadfuls. I'm not saying not to buy the penny dreadfuls. I'm saying to invest before you speculate. If you believe in higher gold prices and you believe consequentially in higher operating margins around gold producers, remember it's important that they produce. Remember, too, the lesson of the decade 2000 to 2010, where the gold price went from $256 an ounce to in excess of $1,800 an ounce, a seven-fold increase in the gold price, and free cash flow per share on the XAU fell. It took real skill to screw up a bull market like that. So make sure when you allocate capital to the gold mining sector that you impose the same discipline on the companies that you would in other sectors. And I'm not saying not to come down into the speculative ones. I love to speculate. It's treated me extraordinarily well, but I work hard. So don't come down into the sector if you aren't prepared to read 10Ks, 10Qs, proxies, management information circulars, and resource statements. If you aren't prepared to do that, stay with the biggies and stay with the best of the best. Remember that all-time high is nominal. If you adjust that all-time high for the purchasing power of the dollar, the all-time high is probably closer to $100. I'm afraid I think we're going to see that price. Um, in my estimation, gold doesn't go higher, it goes much higher. And in my experience, gold leads. But when the generalist investor adopts the precious metals narrative, which has not happened yet, uh, silver takes over leadership. And when silver takes over leadership, it rises farther and it rises faster. And the silver equities, with the possible exception of the uranium equities, would seem to be the most volatile natural resource equities of all. Doug Casey observes that the market capitalizations of the high quality silver juniors, a very small universe, is so small that when the generalist investor comes in the space, there's not enough room in the silo for that money. I remember the early part of the decade of the 90s when we had a spectacular short silver price rally. And we had things like Silver Standard going from 72 cents to $45, Pan American going from 50 cents to $40. You buy these things because you don't know when silver's going to run, and you are willing to subject yourself to breathtaking opportunities because when they do run, the gains that you enjoy pay an awful lot of rent in a time value of money sense to compensate you for being early. I'm delighted right now to see the hate on social media that the small silver companies are enjoying. I think the problem, and we've described this before, is that investors look at a long-term narrative and they employ a short-term strategy. In other words, they think the price of silver is going to go up over 3 years, but they're afraid to hold a stock for 3 weeks. I'm old enough now that I've come to enjoy this habit. I seem to be a pawnbroker for people who are duration challenged. When the narrative gets ahead of itself and the stocks get frothy, you got to sell them a little. When the Twitter space on X is full of hate, you got to buy. Right now, the Twitter space on X is full of hate for silver and uranium. I'm delighted with the disgust in the market around uranium because it's very difficult for me to see any problem with the thesis. I mean, what could go wrong? Over time, technology. You could have fusion replacing fission. You could have thorium. Those are 20-year problems. In the near term, what could go wrong would be a power plant disaster like Fukushima or 3 Mile Island, or perhaps a global depression with a liquidity shortage. Those are things that you need to take into account, but they're unlikely. They're true black swans. What can go right? We have a production deficit. We have a return to favor for nuclear power around the world. The Chinese announced a week ago 8 new builds. Now, announcing and funding them are very different. But the truth is that the pace of Japanese restarts is increasing. The pace of Japanese consumption is increasing. The political wins and financial wins around new plant construction are increasing. Demand 2 years out or 3 years out from plants that are under construction today are guarantee strong uranium pricing. But the most important part of it is the part that the market is ignoring entirely, which is that the structure of the uranium market has changed completely. Unlike any commodity in the world, the producers aren't held hostage to the spot market. There's a term market. A nascent producer, a next gen, a fission, can pre-sell by contract produced material to an investment grade counterparty, Tokyo Electric Power, China General Nuclear, Southern Company, Duke Power, somebody like that, and literally take that contract to the bank. This is a circumstance that I think fundamentally changes the nature of uranium equities, and dramatically for the better. It'll take 5 years before this is in the market because right now these contracts are opaque. The companies, when they can, won't disclose their contracts. And some companies are avoiding contracts because they want the upside in uranium. They want to be unhedged. I personally believe this is stupid. If you take away all my downside, you can take away some of my upside, and I'm a happy, happy, happy camper. So for those reasons, I believe the next 5 years, albeit with some volatility, will be excellent in the uranium equity space. And I'm particularly attracted to the fact that, again, people are employing a 3-month strategy to a 3 or 5 year narrative.
Thanks for sticking with us through today's deep dive into the current state of the economy and the surprising opportunities in the market. To recap, we discussed how the real issue isn't just rising prices, but the declining value of our currency. Rick Rule highlighted the stark contrast between those who can leverage low-cost credit to build wealth and those who are struggling with high consumer debt. We also explored the undervalued potential of silver and uranium, 2 assets that are currently overlooked but could offer significant returns as market dynamics shift. If today's insights got you thinking, make sure to subscribe to the channel so you don't miss our future content.